Thanks for being with us. Let's check in with a frequent guest of ours, Ryan Detrick, as Chief Market Strategist at Carson Group. Ryan, thanks a lot for joining us. You always do a great job of analyzing market history and coming up with some thoughts on what could lie ahead in the future. And in fact, this bull market that we've seen in U.S. stocks is about 2 years old right now. Why don't you take it from there?
Yeah, first things first, thanks for me back, Paul. Appreciate it. And I heard you talking about Taylor Swift earlier. My daughter wants to go in Indianapolis in a few weeks. If anyone has any tickets, send them my way, because they are expensive. We'll leave it there. To the bull market. Yes, the U.S. bull market just hit its second birthday, Paul. The first year of the bull market here in the U.S. up like 21%. People said, oh, it's the weakest first year ever. Well, then we just had the best second year ever, right? So what in the world does it mean now? And my friend Sam Stovall said it like this. Once you get to 65 years old, the odds of getting to 85 is actually really, really good, right? I think bull markets are like that. I went back 50 years, Paul, found 5 bull markets that made it into their third year, like this one is right now. The average, no such thing as average, but still, let's pay attention to this. The average bull market out of those 5 made it to 8 into the 8th year. All right. The worst was 5 years. So who knows, right? But I think the key thing is if you look at history, these bull markets can last a lot longer than you think. Last comment, and I'll turn it back to you. But the third year of a bull market, where we are right now in the U.S., they tend to be a little weak. Why? Because years 1 and 2 are usually great. So maybe we don't gain, 20% over the next year. But, listen, I'm around 10, 12% the next 12 months, perfectly normal. And then this thing can continue. We think there's a good chance of that.
Should investors base their thinking, or at least part of their strategy, on history? How reliable can history be given competing factors like market fundamentals and valuations?
Oh, I mean, listen, we look at a lot of different things at Carson Group. I like to look at history for a guide. It gives us that little bit of a clue. But you're exactly right. What were we hearing, this time a year and a half ago? Oh, only 7 stocks going up. Only 7 stocks going up. Right now, Paul, we have, all 11 sectors in the S&P 500 are up at least 10%. 5 of the 11 are up 20%. This is a broad-based rally. All of a sudden, people left it for dead. We're starting to see small caps do pretty well. We're starting to see mid caps do pretty well. Don't want to get too geeky with this, but there's something called advanced decline lines. It's a cumulative basis, how many stocks going up versus down. Keep this real simple. Hitting all-time highs on the S&P, the Dow, the NASDAQ, small caps and mid caps just in the past week. This is not a thin rally. It's not being led by just a few stocks. It's a broad-based rally. That is something I'd pay attention to. And then we can talk about the economy a lot more if you want. But the reality, the economy appears to be heating up. The U.S. had 3% GDP growth last quarter, and it's looking like it's going to have 3% again. 3% quarters in a row is really, really strong. So again, the economy's strong. There's a lot of market breadth. Yeah, these cycles are still bullish. You put all that together, and it's why I've been coming on you for a long time now, say this is a bull market, we're going higher, we're still in that camp.
We are just weeks away now, just a couple of weeks away now from the U.S. Presidential election, of course. What has history shown us about elections? Is this election any fundamentally different? And what do you expect in early November once the outcome is presumably clear?
And don't get me in too much trouble here, Paul, talking about this stuff. But listen, this what investors need to know right now. This is like the best election year ever. Okay. I mean, usually election years aren't all that great for stocks. But here's the thing. It's usually October you get that banana peel. Just think the last couple elections, at least in the U.S., we saw some weakness ahead of the election. So the S&P's up 5 months in a row. S&P's up 10 of 11 months. Maybe we get some pre-election jitters, but this year clearly is a little bit different. But to specifically answer your question, in an election year, it is what it is. November and December are usually really strong. Now, listen, I know we've had a great start to this, so maybe this year could be a tad different. But from that purely seasonal point of view, November, December, January are the 3 best months of the year. And we don't think I'll tell you what, I'll put it like this. I hope we get a little bit of volatility, maybe a 4 to 6% pullback, kind of like we saw in early August, kind of like we saw in September, get some jitters. There's a lot of people that are awfully excited out there right now because things are doing well. And that's fine. You need bulls for a bull market, maybe some jitters, pull things back a little bit, reset a little bit. And then we would still be optimistic. We're still going to see some strength into the fourth quarter here once we get through the election. Last comment. Markets hate uncertainty, right? They can take good news. They can even take bad news. We've seen bull markets in bad news before. They don't like uncertainty. We think once we get that election out of the way, the fundamentals are going to continue to drive this bull market in the United States.
Your call remains overweight equities, obviously. Tell us more about what's about that call. What sectors in particular you prefer?
Absolutely. We actually moved to overweight equities. Overweight equities. I can't even say it. It's so rare to hear people say it. In December of 22. So we've been there ever since, right? It wasn't a very popular call in 23 when we said that, but here we are. Now, again, I kind of talked about this broadening out, right? We like the cyclicals, industrials, financials. I mean, those two groups have been really, really strong lately. Financials specifically been really strong. Why? Because the banks had really good earnings. They are making more money, right? The consumer is still strong. So the consumer is still hanging in there. Industrials, financials are two groups we like, and then small and mid caps. I know small caps are a dirty word a lot of times. Russell 2 is up like 13% for the year. Yes, S&P 500 is up about 10% more. But listen, historically, Paul, it's when you start to see the Fed cut. That is when small caps and mid caps start to have alpha, some outperformance with an economy that's hanging in there. And also, last comment on this, if you look at, well, two comments, valuations, okay, of large cap relative to small. Small's in like the 99th percentile. It's the cheapest like it's ever been since the late 90s relative to large caps. But then look at earnings, right? Earnings in the S&P next year, let's call it between 12 to 14%, depending on your source. Small cap earnings are supposed to be up, maybe 5 or 6% more than that. We think that even might be a little low. So there's more earnings growth, and they're cheap on the small and mid cap size. And those are some areas we continue to remain overweight right now.
Ryan Detrick, thanks a lot for joining us, and best of luck in the Taylor Swift ticket market.
I was going to say, yeah, the reminder, send me Taylor Swift tickets, anybody. Indianapolis, November 3rd. I appreciate it. See you, Paul.
Ryan Detrick, Chief Market Strategist at Carson Group. Up next, why our featured guest this morning likes stocks in Japan after this.